The silver rally of 2025 and the warning signs beneath the surface. Throughout the history of financial markets, one principle has remained consistent. No trend lasts forever. Extreme price movements, whether upward or downward, eventually slow, stall, or reverse. This pattern has repeated itself across stocks, commodities, and currencies for generations. Today, that reality brings us to one of the most talked about developments in the commodities space, the powerful silver rally of 2025. Silver has experienced an extraordinary run, capturing the attention of investors, analysts, and everyday observers alike. Prices have surged at a pace few anticipated, and optimism has reached levels rarely seen in recent decades. While excitement is understandable, history teaches us that moments of euphoria often deserve closer inspection. The big question many are asking is not whether silver has performed well, it clearly has, but rather how long this momentum can continue. Whenever markets move aggressively in one direction, certain indicators begin to flash caution. These indicators do not guarantee an immediate reversal, but they do suggest rising risk. Ignoring those signals entirely can lead to poor decision-making. This channel has always aimed to present precious metals news with balance, highlighting both opportunity and risk. Recently, a respected analyst within the metal space has raised an important cautionary flag. Interestingly, this warning aligns with concerns that have been quietly building since the rally first began. Even those who strongly believe in silver's long-term value must acknowledge that markets often overshoot before correcting. It's easy to get caught up in the enthusiasm of a bull market. Many investors, myself included, have felt the excitement surrounding silver's rapid ascent. However, it is equally important to step back and consider silver's role over the long sweep of history. Silver's true worth is not defined by short-term price spikes, but by its intrinsic value as both a monetary metal and an industrial resource. For centuries, silver has functioned as a form of money, a store of value, and a critical component in manufacturing. Modern markets often treat it primarily as a commodity, and that perception has played a major role in driving the current rally. Rising industrial demand, inflation concerns, and currency debasement fears have all contributed to silver's renewed appeal. Many analysts predicted that silver would eventually rise. What surprised nearly everyone was the speed. Prices didn't climb gradually, they accelerated. The market moved from steady gains to near vertical advances in a remarkably short period of time. In market terms, this kind of move is often described as parabolic. A parabolic rise means prices are increasing at an unsustainable rate, driven largely by momentum and emotion rather than fundamentals alone. On daily charts, this appears as prices moving almost straight upward. Screenshots of silver charts have spread rapidly across social media, fueling even more excitement. While this kind of movement looks impressive, it is rarely stable. Parabolic trends tend to end not because the asset lacks value, but because the pace of buying cannot continue indefinitely. Eventually, buyers become exhausted, profit-taking begins, and volatility increases. Recent price action has already shown hints of this instability. Despite the strong upward trend, silver has experienced sharp pullbacks along the way. These dips serve as reminders that even in bull markets, prices do not move in a straight line forever. Adding to the conversation, veteran analyst Jim Wyckoff of Kitco has pointed to specific technical indicators that deserve attention. One of the most important among them is the Relative Strength Index, commonly referred to as the RSI. The RSI is a momentum indicator that measures how quickly and how far prices have moved over a given period. When RSI readings climb above certain levels, it suggests that the asset may be overbought. Traditionally, an RSI above 70 signals that prices may be due for a pause or correction. In silver's case, the RSI has reached levels that are historically rare. Looking at long-term monthly data going back to the early 1970s, the current RSI reading is among the highest ever recorded. The only comparable instance occurred around January 1980 during silver's legendary price spike. Back then, silver surged to approximately $50 per ounce, an extraordinary figure at the time. When adjusted for inflation, that price would exceed $200 today. Shortly after reaching that peak, however, silver experienced a dramatic collapse. Within months, prices fell sharply, erasing much of the prior gains. Of course, history does not repeat itself exactly. Market structures, regulations, and global conditions are different today. Still, human behavior has not changed. Fear and greed continue to dominate market psychology, especially in commodities. The elevated RSI reading does not mean silver must crash tomorrow. Instead, it suggests that the market may be approaching a point where upside momentum becomes harder to sustain. Corrections can take many forms: sharp drops, extended sideways movement, or gradual pullbacks over time. What makes this moment particularly important is the combination of technical signals and growing public attention. When mainstream media and the broader public begin focusing heavily on an asset that has already made major gains, it often marks a late stage in the cycle. This phenomenon has played out repeatedly across different markets. Early participants enter quietly, prices rise steadily, and only later does widespread attention arrive. By that point, much of the upside has already occurred. That does not mean the long-term case for silver is invalid. Far from it. Silver's fundamentals remain strong, and its role outside the traditional financial system continues to attract serious interest. The key challenge is separating long-term conviction from short-term market dynamics. As the silver rally continues, understanding these warning signs becomes increasingly important. The next phase of this market will likely test both patience and discipline, qualities that matter far more than hype when navigating any major financial trend. One of the most powerful forces driving any financial market is psychology. While supply and demand matter, price action is often dominated by human behavior, fear during downturns, and greed during rallies. Silver's recent surge provides a textbook example of how sentiment can push prices far beyond what many thought was possible. Experienced traders often say that markets become most dangerous when optimism feels universal. When nearly everyone believes prices will continue rising indefinitely, risk tends to increase rather than decrease. At that stage, even small changes in sentiment can trigger significant moves. Veteran market participants understand this well. One common lesson passed down through trading floors is that when a market move becomes widely discussed by the general public, it may be approaching a climax. This doesn't guarantee an immediate reversal, but it often signals that the easy gains have already been made. Silver now finds itself in this zone of heightened attention. Media coverage has expanded, retail participation has grown, and conversations about silver prices are becoming more frequent outside traditional investment circles. These developments suggest that psychology is playing an increasingly large role. However, it's important to recognize that not all outcomes following a bull run are negative. In many cases, strong rallies lead to a resetting of long-term price levels. Even after corrections, markets often establish higher floors than before. This concept is central to understanding the bullish case that still exists beneath the surface. According to recent analysis, both gold and silver may be transitioning into new price ranges that could persist for years. For gold, analysts are increasingly pointing to the $3,000 level as a potential long-term support zone. Just a year ago, gold was trading significantly lower. The rapid revaluation suggests a structural shift in how gold is perceived globally. Silver appears to be undergoing a similar transformation. Instead of returning to the $20 or $30 levels that dominated much of the past decade, silver may establish a new base in the $45 to $50 range. If this holds, it would represent a major victory for long-term holders. Even a correction down to the low $40 would still mark a dramatic improvement compared to historical norms. For years, silver struggled to sustain higher prices despite growing industrial usage and monetary uncertainty. The current cycle may finally be correcting that imbalance. This is where the distinction between price and value becomes critical. Price reflects what buyers and sellers agree upon at a given moment. Value, on the other hand, reflects the underlying importance and utility of the asset over time. Silver's value has arguably been underestimated for decades. Factors such as paper trading, market interventions, and shifting investor preferences contributed to prolonged periods of undervaluation.
the recent bull run may be forcing a long overdue reassessment. Another interesting aspect of the current environment is the opportunity found in less popular segments of the silver market. When speculation dominates, attention often concentrates on headline prices and high-profile instruments. Meanwhile, quieter areas, such as older coinage and physical holdings, remain overlooked. Historically, assets that receive the least attention during speculative phases often perform well once sentiment shifts. When the crowd rushes in one direction, opportunities sometimes emerge elsewhere. It's also worth emphasizing the importance of independent thinking. No analyst, no matter how experienced, can predict the market with certainty. Even respected voices acknowledge the limits of forecasting. That's why responsible commentary avoids telling people exactly when to buy or sell. Ultimately, each investor must weigh their own